Welcome to Indianomics. I'm Latha Venkatesh. The big breaking news is that retail inflation, or CPI, for the month of October has come in at a record low of 0.25% against 0.44% in the previous month and against 6.21% in the year ago, October. The lower inflation of 0.25% is largely on the back of very low food prices. The food inflation is actually a deflation at minus 5.01% if you compare it year on year. Month on month as well, the overall food inflation is down by 0.25%. That is October over September. We are clearly headed for a longish bit of low food inflation because this is the fifth consecutive month that we have got a negative food number. The impact of the GST also has to be taken into account when we look at food and at core inflation. To discuss all this, I'm going to be joined by a group of economists. In a bit, we will be joined by Ghosh, the Group Chief Economic Advisor of SBI. He joins us a little later. At the moment, I have with me Suvodeep, Rakshit, the Chief Economist at Kotak Institutional Equities, Kanika, Pasricha, the Chief Economic Advisor at Union Bank, and also on the show is Devang, Shah, the Head of Fixed Income at Axis AMC. Kanika and gentlemen, thank you very much for your time. Suvodeep, let me start with you. As you pour through the numbers, we find that month-on-month food inflation has fallen for cereals by about minus 0.01%. For oils, edible oils, a weighty item again, like cereals, it's fallen month-on-month by 0.4%. Fruit is down about 1.5%. Pulses are down about 0.5%. These are month-on-month numbers. The fall year-on-year is significant for vegetables, 27% fall. Spices as well, there's a fall. Pulses have fallen by 16%. What is your sense of the trajectory? Are we going to continue to see food prices in negative terrain?
Sure. I think the numbers that we have today are 0.25%. The headline is broadly expected. We were looking at 0.28%. And the numbers that you talked on the food prices, I think that was also expected because this is typically the seasonal period where food prices, especially when you look at the short cycle crops, they start to decline. This will continue roughly till around December or January. And in some sense, that will set the trajectory for the food inflation, which I think for the next 2 to 3 months should continue in the negative territory. Food and beverages.
What does this do to the overall inflation, the headline inflation? Sure. What do you expect the annual average to be and the quarterlies?
So I stick with my annual average of 2.1%. For FY26. I'm not getting into the FY27, but just to complete the FY26 part, if you look at the next few prints, I think we are, for the next print, we should be sub 1%, closer to, let's say, 1%. And then on till March, it gradually keeps on increasing to roughly around 3.5%. So that's the trajectory I'm looking at for the rest of FY26. Of course, the assumption here, and I think it's a fair assumption as of now, given the monsoon, etc., that the food prices are not seeing any kind of sharp pickup over the next few months.
Okay, so Q4 you may get about 3% is what you're saying.
Correct.
Okay, Kanika, what is your annual expectation? And therefore, do you think that, first quarter next year, the Reserve Bank had set 4.5%, brought it down from 4.9%. And that was one reason why we thought the Reserve Bank is not cutting rates, because year ahead is above 4%. Now that also goes down, you think?
So, Latha, thanks a lot for having me. In fact, Latha, for the last 2-3 months, we've been claiming that FY26 average was tracking close to 2 to 2.3. In fact, for us, this print was, the estimate was 0.38. It's come in lower at 0.25. Now, when we are looking at numbers where vegetable deflation is still pending, it's only down 0.28% month on month this time. So, in our view, FY26 tracking 1.8%, current quarter 0.5 versus 1.8 from RBI. Next quarter, we are actually at close to 2.5 versus close to 4% from the RBI. For Q1 next year, while the RBI has revised it lower to close to 4.5, 4.7, we are at 4% with a downward bias.
For the year, quarter, that is for the April, May, June quarter.
Yes.
Okay, so the year ahead. Now, Devang, how will the market receive this? Will you see yields fall, or have we already seen them fall because of an expectation of a rate cut?
Yeah, so Latha, as you rightly pointed out, I think probably market is now expecting a rate cut in December. So our view is that probably we would see a very high probability of a 25 basis cut in December. Government bond deals are actually, I think, somewhere down the line, because we have seen in traditionally also over various cycles in fixed income markets, they don't react to the last rate cut. And in fact, we see sell off after the last rate cuts. So markets are looking out for, first of all, is the trajectory significantly below 4 for next year? Secondly, how is the tariff deal going to play out and what is the impact on growth? So our view is that bond markets have actually probably started looking at more the futuristic data, which is next year's inflation and growth dynamics. And also the bigger overhang has been on the demand supply dynamics, which has been the imbalance on long bonds, the imbalance because of higher SDL supply. I think that is leading to no significant rally on bond markets. But answering your specific question, yes, our view is that getting into the December policy, bond market yields should see around 5 to 10 basis rally from the current level.
What is the bond market right now penciling in a cut in December? If you look at OIS.
So not completely. I would say the swap markets are pricing in around 8 to 10 basis of cut. The bond yields are probably pricing in 50% probability of a rate cut. So if the 25 basis rate cut comes through, I think we can see. It will be all dependent on the future trajectory of rate cuts, whether it is a last rate cut or probably we can see one more. If there is one more, definitely bond markets will continue to see a downward trend.
Okay. Well, the important point to note now is that food inflation is minus 5.02. Core inflation has come in at, I think, 4.4, or for some people it is 4.35, depending on what you take. But for everyone, the non-gold core inflation, in core we tend to take gold because personal services is included in core inflation. There you also have a gold item. If that's taken off, then it falls to about 2.6%. Is that right, Kanika?
So Latha, for us, that number is around 2.7, 2.75. Yes, there can be a statistically different ways to calculate it.
Fair enough.
Nice significant change there. For September, this number was 3.15, 3.2. It's been revised lower to 2.98.
Yes.
And the reason why the September number has been lowered is because housing inflation has been lowered from 3.98 to 2.98. There's a 100 bips delta shift.
Okay.
So that is leading to core X gold also showing a even more tepid trajectory now, and yes, well below the 3% mark.
Okay. Well, between now and the monetary policy, there are no CPI numbers, but there's one big giant GDP number that comes out on November 28 for the months of July, August, September. Rakshit, Suvodeep, what is the expectation over there? And if it is 7 plus, does that give the Reserve Bank a reason not to cut?
So I think from a policy perspective, growth is not the concern if you go by the GDP print. If you look at activity indicators, etc., you can have various indicators which could point to a bit of a slowdown. But honestly, if you look at the GDP prints, even in the first quarter, same will be with the second quarter. I don't think there is a problem in terms of growth if you look at it from a real GDP.
What are your numbers?
7% plus is what we are looking
for
at.
the second quarter. Okay.
Correct. But again, if you look at the nominal GDP, I think there lies much of the problem. And I think a nominal GDP growth of, let's say, 8% or a 9% is not something that is signaling a very strong growth per se. So from that perspective, if you go by from a policy perspective, I think the inflation is a clear positive for rate cuts. However, the external sector balance as well as the growth part, I think will put the RBI in a more cautious mode. So I think the policy is a close call in that sense, though we stick with a 25 bips rate cut at a fine margin.
Okay. What are the chances, Kanika, according to you? Wait, before that, Suvodeep, are you yes for a rate cut or no?
Yeah. We are for a
you are expecting
rate cut, but yeah, it's a close call.
Okay. Kanika, what's your call?
We have a clear call of a rate cut, 25 bips.
Okay. And Devang, what's your call?
Yeah, we are also of the view that December is a very high probability of a rate cut.
Okay, so here we're going with a 3-0 in this house. After the break, we will have Soumya and let's see what how he votes. See, it's Kanika is there on a very good probability that the Reserve Bank says we have space to cut, but we don't have to use that space now. There may be times to come. Is that a very good likelihood? Not merely because the GDP number may be well over 7. I mean, who expected the 7.8? A dipstick survey showed me that the second quarter could be 7.5 very easily. I mean, at least some people have that point of view. If that's the number, the Reserve Bank is in a very awkward position of cutting rates when the growth in the just completed first half is something like 7.6. Kanika, you think that possibility, that awkwardness will prevent the Reserve Bank?
So let's have 2 points there. First is on growth. We completely acknowledge, in fact, our number for Q2 is showing close to 7.5%. But we also want to await corporate earnings to finalize that. But growth in second half likely to slow. As Suvodeep mentioned, there is a deflator impact even in this quarter, which may actually very well persist in the third quarter as well. However, second half base effects fade away. So growth likely to slow down. This was acknowledged by MPC even in October. Second, an inflation targeting MPC has to acknowledge inflation numbers consistently undershooting their projections. And now the number for this quarter tracking 0.5 while they're at 1.8. So such sharp undershooting must lead an inflation targeting central bank to pay some credence to inflation numbers as well, especially when nominal GDP growth is under downward pressure.
Okay, so I take your point. I take your point entirely. In fact, I'm wondering if we can show the entire inflation chart. It may be difficult. From the month of January, for calendar 2025, there is only 1 month where the CPI headline is above 4% at 4.2 for January. From February onwards, the decimal point is 3 point something, and it's consistently falling now to 0.25%. And without gold, it would have been negative. So clearly, the Reserve Bank will have, the MPC will have a lot of explaining to do. We already saw in the previous MPC some of the members asking for the stance to be changed back to accommodative. Of course, they were in a minority. And of course, the stance is not the external members' responsibility. But there is a heavy moral pressure as well on the Reserve Bank to look at inflation. As Kanika has been saying, it's going to become a very interesting policy indeed. Well, Devang, Kanika and Suvodeep, thank you very much for joining me. This House votes 3-0 in favour of a rate cut in the coming policy. And they are also looking at a 2% inflation for the full year, 2 to 2.1. The Reserve Bank is still sitting at 2.6. With that, let's go into a break. We will be joined by Soumya, Ghosh, the Chief Economic Advisor of State Bank and the Finance Commission member in just a minute after the break. Welcome back. We've got a dramatic inflation number for October at 0.25%, an all-time low as far as the new CPI series is concerned, and pretty much a record low if you look at India's record even before the new CPI index. Joining us to glean how the inflation trajectory will be and what this will do to the upcoming Reserve Bank policy on December 5th, I have with me Soumya Ghosh, Group Chief Economic Advisor at State Bank of India and a Finance Commission member. Soumya, thank you very much indeed for joining us. Well, actually, you were the only one in my poll who gave me a minus number. Minus 0.1 was your guess for the month of October. By your standard, this is actually higher than expected inflation. What do you make of this? I mean, if it's a minus number, what does it do to policy?
Yeah, actually, Latha, our number is actually lower than the headline CPI without the gold, which is at minus 0.57%.
Oh, without gold, it is minus 0.57.
Minus 0.57%. And next 2 months also, the headline CPI could be in the negative territory if we just exclude the gold out. So having said that, if we leave aside that statistical artifact, even for the next 3 months, the inflation numbers will be less than 1%. So that means that the second quarter inflation could be well below 1%, well below the RBI number. And the third quarter could be around 3 to 3.2%. As of now, it could go even lower depending on how the food prices pan out. So overall inflation for the full year, as you had just said, could be 2% or lower. And the most important point to note here is next year inflation number also gets bumped down, and it will be much lower than the RBI projection of 4.5% at this 4.2% at this point of time. So if I take all these factors into perspective, I think, and this is going to have a period of inflation disinflation now, if I call it, because inflation has been declining consistently now from the central bank projection. The central bank projection in April, if you remember, was 4%. It came down to 3.7, then it 3.1. Now it is at 2.6. It could be even lower by that. And every estimate is now lower by around 50 to 60 basis points. So if I take all these factors into consideration, I think the inflation numbers will surprise on the downside. Now it's a call for the central bank to take in the December policy of what it is going to do.
Okay. No, that point is taken. Actually, in which month do you think inflation goes back above 2%? The Reserve Bank's mandate is to keep it between 2 and 6, right? 4% plus or minus 2%. So already from the month of July, it is under 2%. Okay, August, it goes a little above, but basically July, August, September, October, already it is practically below 2%. When does it climb above? In January, February?
I think maybe very close to 2% in January, but in February and March, it should be over 2%. And in March, whether it crosses 3%, that will be a matter how the food prices trajectory works out. So,
Fair enough.
Maybe you can take this February.
Yeah, but just as I was asking the Economist before you, between now and the monetary policy, there is this big GDP number which comes out. What is your estimate of the growth numbers? And would that be a good reason for the Reserve Bank to say we have space to cut, but we don't have a need to cut?
Now, of course, Latha, I think the most important dimension of this entire growth story has been what we were discussing at the beginning of the year, that the second half would be actually weaker than the first year. That is not going to happen if you look into purely in the numbers now. So because the second quarter GDP, our estimate is actually not be surprised if the number crosses 7.5%. Currently, we are getting a number in excess of 7.5%. You have to fine tune the number. But I will not be surprised if the number is even higher than 7.5%. And then the third quarter GDP, if you look into the October, whatever I can gather from the October sales, their consumption boost and other things, it was actually significantly just stupendous. So from that perspective, the third quarter will also be not a letdown. But for now, for the December policy, the RBI has the GDP number in front of it, which could be around more than 7.5%. And that actually could be the deciding factor of deciding whether to cut now or later. But the important and on a lighter note, the interesting point is that in the February policy, the RBI will not have the Q3 GDP number, which will be released only in the month of February end, which could be even higher than the second quarter. So from that perspective, I think maybe it's a very close call between December and February. But I would stick my neck out to say that maybe February could be the best bet to cut if the RBI decides to go ahead.
Fair point. The Reserve Bank will have the full year first advance estimate from the MOSPI, which if it has a 7 handle, then it makes it a little awkward to give a cut at that time. But do you think that the Reserve Bank will be bogged down by its mandate? The mandate is that you cannot have inflation below 2%, and therefore it gives a cut. Also, if it gives a cut, do you think the bond markets will even respond? Because it will be the last cut. So do you think there will be a very big fall in the cost of capital?
No,
it could be a wasted cut, is what I'm asking.
Yes. No, Latha, I think that's a very fair point, because I think the possibility, this is my point, is that the base point to cut possibly could have been in October. August, I may rule it out because June there was a jumbo rate cut. But I think the base time to cut may have gone. But the inflation and also the fact that if the RBI cuts now, the bond market may not react favorably, because credit growth, if you look at another interesting dimension, is that credit growth is now started to outpace deposit growth, because credit growth is in double digits, deposit growth is single digits. So if that is the case, so basically the RBI may have to now look for some liquidity policy adjustment on other things, rather than purely concentrating on a rate cut at this point of time.
Just one more technical point, which only a person like you will know. The new CPI series comes in February. We are given to understand that rent is going to be differently calculated, and it may be higher because they may take market rents. Also, food will be lower, and that is the one that is depressing the inflation. So do you think that may change the arithmetic going forward, that we may not have such a low inflation?
Exactly. I think even if these points are well known earlier also, that food inflation is going to play a major part. Even if the weight of food inflation goes down, even if it goes down, say, by 3%, 45 to 42%, I think the overall headline inflation at this point of time was getting impacted by 20 to 30 basis points. So I'll not be surprised if the overall headline inflation gets a further downward bias because of the new CPI series, which will be released in February. So that is another uncertain point at this point of time, which the central bank may have to watch out for. But that will actually happen after the RBI February policy. So there is a lot of moving parts at this point of time. The November GDP print, the January full year CSO number, the February quarterly number, and the new February CPI series, which will be published after the RBI February policy decision.
Fair point.
So with so many moving parts at this point of time, it's difficult to make a guess. But as a mandate for the central bank, if it goes by inflation targeting, it needs to cut rates, but that's a call with the central bank. Will take very judiciously.
Fair point. But your December vote is cut or no cut?
Yes, as of now, I am holding out for a pause in December.
Pause. All right. Thank you very much, Soumya Ghosh, for analyzing so many moving parts. Thank you very much for joining us. You can't envy the Reserve Bank at this point in time, because probably in the December policy, they have to revise up the growth forecast to probably 7%, and they have to bring down the inflation forecast to probably 2%. And at that point, growth doesn't need help, but inflation gives you space to cut. That would be a dilemma they have to, encounter. A second dilemma is everyone knows that the real inflation we face is not 2%, because there is no national indicator for health. There is no national indicator for the price of education. We all know that private school fees are going up, but that's not reflected in the inflation. So inflation is not really 2% or 0.25%. On the other hand, growth is also not as good as 7.8 because of the impact of the WPI inflation being very low, the deflator being low. So the Reserve Bank has also to contend with the fact that growth is not as good as it looks, inflation is not as low as it looks because of statistical problems. So I don't envy the Reserve Bank, but December 5th remains a close call. That's it on this edition of Indianomics. Thanks for watching. More news and updates are lined up after the break.